What are examples of the tax burden? Have you ever wondered how property taxes can impact your real estate investments? Understanding the tax burden is essential for any investor. Let's break down some examples of what this tax burden looks like in real estate investing. First, property taxes are calculated based on the assessed value of a property and the local tax rate. This is often expressed in mills, where 1 mil equals $1 of tax for every $1,000 of assessed value. For instance, if your property is assessed at $50,000 and the mill rate is 20 mils, your annual property tax would be $1,000. This amount reflects the tax burden you carry as a property owner. Next, it is important to note that different areas assess property values in various ways. Some places tax the full assessed value, while others only tax a portion. For example, in South Carolina, only 4% of an owner-occupied property's assessed value is taxed. This results in a higher tax rate to make up for the lower assessed value. In contrast, the District of Columbia taxes 100% of the assessed value but at a lower rate. This means that the effective tax burden can vary significantly based on where your property is located. Speaking of location, property tax burdens can differ widely from one state or county to another. Some areas have low effective property tax rates, sometimes as low as 0.5%. On the other hand, certain counties in New Jersey and New York have median property tax bills that exceed $10,000 annually. This variation can greatly affect your cash flow and overall returns on investment. Additionally, many states provide exemptions or caps that can help reduce the property tax burden for specific groups, such as seniors or veterans. Homestead exemptions can lower the taxable value of a property, while circuit breakers limit tax liability for low-income or elderly homeowners. These benefits can significantly lower the effective tax burden and may influence your investment decisions, especially if you are targeting properties that qualify for these exemptions. Let's look at a practical example of how to calculate the tax burden. If a property is appraised at $100,000 and the local assessment rate is 35%, the assessed value would be $35,000. If the mill rate is 1 mil, the tax per mil would be $35. If the total mill levy is 20 mils, the total tax burden would be $700 annually. This calculation shows how the assessed value and mill rates work together to determine the tax burden on a property. Understanding the tax burden is vital for real estate investors. Property taxes are a recurring expense that directly impacts net operating income and overall investment profitability. By considering local tax rates, assessment ratios, and any available exemptions, you can make more informed decisions about your investments and ensure accurate cash flow projections.